Good afternoon, everyone. A couple of questions came up with respect to the unit cost of inventory. It seems that, and again, these are good questions because I don't always get them during the class, and it's good that you email or come up to office hours. It seems that the purchase discounts, when they're coming out of merchandise inventory, was somehow elusive to a lot of people. In other words, I don't understand why we're doing that, and not really clear. Well, let me use this example. We've got, let's assume you have no beginning inventory, and I'm trying to use I don't remember, I just did this from my head if it's the same numbers we had before. You purchased 100 units at a cost of $350 each, so that's $35,000. Then at some point, you had an allowance against that inventory. Now, you didn't return the inventory, so you still have 100 units left, correct? So you didn't return it. You just got an allowance. Let's say the inventory came in. It didn't meet specification. There could be some damage. Whatever it might be, it needed to be credited, or you reduce it for 7. So I want to stop right here. And basically, at this point, your inventory is now carried at $28,000. The $28,000 doesn't mean you have fewer units, you just paid less. Now, the questions I was getting seemed to imply that you had less inventory. You have the same number of units, or fewer units. You have the same number of units, but a lower cost. And the same thing is true with the discount. Or conversely, that the freight increases the cost of inventory. And then when you take the purchase discount, don't forget the purchase discount does not include the freight. Purchase discount only goes against the balance that you owe for the merchandise, so that your balance of your inventory is $27,220. So it's just like buying something on sale, or if the product is discounted at a department store, you still have the same number of units, but you're just paying less. And that's all the discount and the allowance would mean. So that if you now, and we're going to apply this today, if you want to get a cost per unit, you still have 100 units, but those 100 units now cost you $272.20 rather than the $350. So those units are now lower in cost, but not in quantity. It's the same quantity. Now, beginning today, we're going to start looking at the issue with respect to, or that involves, unit cost and cost per unit. So just remember that the purchase allowance, purchase discount reduce the cost per unit, but not the number. Of course, a return, if you returned it, that would reduce the number of units. A return would reduce the number of units. Okay. So if you had that question, hopefully that clarifies it. Does anyone have any other questions about the purchase returns? I had a few during office hours with respect to the discount. You could have one of the homework questions has multiple discounts. In other words, you've got multiple purchases with more complication because you've got discounts at different rates. But let me know if you have any. Always email. I'm answering emails pretty quickly, I think, unless they're after, like, I don't know, 8 o'clock or something, or 9 o'clock. It depends, but I'm answering them pretty well. And if not, you might get one from me at 4 in the morning or something. So if you're up, you can answer it. Okay. All right. Any other questions on this? Okay. All right. Now, we're going to get into the detail of Chapter 6. And a lot of you have been starting the homework. I also realize that the due dates for homework for 8 and 6 collide. I will move 8. Obviously, I know I have to get in there and do that. I will. So anything else before I move into the second learning objective, where we start now worrying about valuing inventory? The key here is going to be for the valuation of inventory and the cost of goods sold. So this is the second learning objective, or the second goal of this chapter. We're now going to look at inventory valuation. Inventory valuation. And inventory valuation under a perpetual inventory system will involve 2 key items. And those 2 key items are the valuation of ending inventory and the cost of goods sold. Now, you're going to find out that the ending inventory and the cost of goods sold are related. the inventory value that is used will affect the cost of goods sold. The cost of goods sold you calculate will affect the inventory value. If you remember, when we looked at this problem the first time, let me just bring up this again, if not I'll redraw it for you. Oh, let me do that, I'll just redraw it. If you remember, the issue that we said was that if you have a beginning inventory and then you have a series of purchases, that would become the goods available those are either in ending inventory or those are sold. COGS is the cost of goods sold. And these have to be equal. So the total number of units and the total cost that become available are allocated to either the ending inventory and the cost of goods sold. And of course here, you always have to think about a physical count of that inventory, even if you have perpetual records. So even if you have a perpetual inventory system, you still have to count the inventory. The inventory has to be counted and verified. On Friday, if you remember, when there's a shortage, what do? We roll that through the cost of goods sold if there's a shortage, but we still have to be sure that we take the physical count. And again, notice that if you have a shortage in ending inventory, it's going to affect the cost of goods sold. So it's going to be related. Very simply, if you have $100 of goods available, if $40 goes to inventory, then $60 has to go to cost. So it's a scale that has to balance. Now, what we're going to do in this chapter is we're going to look at the computations of how do we allocate, or what methods could we use to allocate the total cost and units available to the units and cost of ending inventory and the amount that is sold. Okay. Now, when we take a look, and let me bring this back up on the screen for you. So if you look at the calculation, we're going to now be looking at unit cost and the number of units on hand and the number of units sold and the cost of goods sold. If you go back to that first illustration I did for you a few minutes ago, you'll notice that the unit cost, although you won't be getting into it in this course, the unit cost would be affected by things like freight. We'll do it much more simply than that. Freight, it would involve purchase discounts, purchase returns, and so on. Now, to start you off with a simple issue, we need to value the inventory. And again, if we're trying to allocate this goods available to ending inventory and cost of goods sold, if prices don't change, if I have a constant price, then if I have let's say I have a price of $20 a unit, once I know the units in ending inventory, then of course the units in cost of goods sold are also at $20. So if the price is constant, it's pretty simple. The problem is if prices are changing. How do you know what units are in ending inventory? How do you know what units you've actually sold? And you might say, well, I can easily track that with a barcode or a scanner, but sometimes you can't. The example I gave today in office hours was, what are you going to do if you're a company that sells fuel oil? So you see the truck pull up to a gas station, and that gas station is unloading fuel in the tanker. There could have been fuel they had in the tank from last week. They could have filled up this morning, and now they're depositing that at your location. What's the cost? It's an average. So sometimes you have to use an average cost. So if you can't identify the units, you sometimes use an average cost, or you have to come up with an assumption of how the units flow out of your business. Now, of course, there could be ways that you could simply identify them, and if you could identify them, fine. You could identify them, you have no allocation problem. So you'll know exactly what cost of inventory remains, and you know exactly what cost that you've sold, but that's not always the case. You could do that, as we'll see in a couple of slides from now. You could do that in an automobile dealership. How does an automobile dealer know the cost of the car? He's got a vehicle identification number, correct? Jewelry, other expensive items that you sell in very low volume, it's very, very simple to identify. So let's do an example, and I'm going to let me get the slide up for you first to show you where we are. So we're going to do a simple example, and this is going to be with a constant cost, and what I'll do to make sure you can see it, I think this is a little bit easier. We'll just make it a little smaller. It's easier for you to see. Okay. All right. So if we take a look at this situation, and this is where we've got a constant unit cost. So you bought units at the same price throughout the year. So your beginning inventory had 2 units, and it is at $3.50. Then you go out and purchase 4 units at $3.50. Now you got 6 at that same price. Then later in the period, on August 26th, you buy 12 more units, still at $3.50. And of course, you've got 14 in inventory, and then when you sell them, you got 4 left. Now, because everything is at the same price, the allocation problem really doesn't exist. The units you have on hand are going to be 4. You sold 14, and what gets a little confusing, and I'm trying to keep what I do with you as consistent as possible with the textbook, what gets a little confusing with the textbook is that it looks like this doesn't add up. But I've got 16 units purchased, but I have what? 2 at the beginning. So essentially, I've got 2 units. If we do this by units, I've got 2 units to start. I purchased 14, and I purchased 16, excuse me. Purchased 16. I have 18 available. The ending inventory is going to be determined by saying that if I sold 14, then 4 have to remain. Yep. Yeah. The beginning inventory comes from the previous month, because the balance sheet inventory account is what? Cumulative. So in this example, as I said, the textbook may not make this clear, but you did start with 2 units at $3.50. You bought 16 at $3.50. You had 18 available at $3.50. So if you sold 14, it's got to be at what cost? $3.50. It can't be any different because you don't have any other cost, and the remaining inventory is also at $3.50. So if we go back, and again, remember, that's going to add up. It's always, this is like a balancing scale. Whatever's on one side has to be allocated. Whatever comes in, the 18 units have to go out, and that has to be at 18 units. So the ending inventory would be 4 units at $3.50 or $1,400, and the cost of goods sold would be 14 units at $3.50 or $4,900. If we look at the allocation, if you had 18 units, and I see people copying this, I won't take it off right now, but if you had, if you wanted this in dollars, you have goods available. Your investment in inventory is about $6,300, and the 14 units that you sold are going to be 49, and the ending inventory is 4 units at $3.50. So you notice that the sum of cost of goods sold and the ending inventory have to equal what you had available. Just like the units have to equal 18, the ending inventory and the cost of goods sold have to equal 63. Okay. So that's the foundation or the base example. No changes in unit cost. So everything's very simple. Everything's at the same cost. Now, the problem gets much more difficult when we have changing prices. When prices change or input costs change, the problem becomes a little bit more difficult. All right, so now let me go back. And up on the screen, you can see the unit cost stays at 350. 18 units available for sale, and 4 are left at 1,400 or 350 each, and then of course 14 at 49. Now, moving to a realistic problem where unit costs change every time you buy a unit, we now have to think about a way to make that allocation. How do we make the allocation? Do we specifically identify, do we know, for example, in this case, the cost of the 4 units that we sold? I mean, if the prices are changing, how do we know which ones we sold? If not, we may need to make some cost flow assumptions. So when we look at the changes in cost, you know, we're changing the example now. Yeah, we start off, and I'll put this up on the screen in a second, we start off at 350, but now we're looking at rising prices. We're experiencing inflation. So costs are going to 360 and to 380. And now we have to think about one of the generally accepted accounting principles that we can use, and there they are. So we can either use a specific identification method. More likely you'll use something known as FIFO, first in, first out, last in, first out, or weighted average. And my objective or our goals today is to be sure that we understand not only how these methods work, but number one, why they're used or when you're going to see them in practice, and secondly, how they affect income and the balance sheet. Because when you look at that scale again, what do the scales say? Some of it goes into ending inventory. Where does that show up? What statement? Balance sheet. And cost of goods sold is the other component. Where does that show up? Income statement. So the method that you select will have an impact on your inventory valuation and your cost of goods sold. When it affects your cost of goods sold, it's going to impact your net income. So here's the story for everybody, not just accounting majors. The story is, if you understand or know the method that the company is using, if you're a loan officer, if you're working in a commercial bank, if you're thinking about investing in this company, their net income could be affected by the method that they use to value inventory. In some cases, their income could be higher or lower. And of course, when you look at the balance sheet value could be changed as well. The balance sheet value is important because you may need to use inventory as what? Collateral. So if someone comes in for a loan, what's going to back the loan? If it's a short-term line of credit to keep remember we talked about that operating cycle, and you understand that the company puts cash into the business and then holds the inventory, then has to sell it, and then has to collect it. If that cycle is slow in any way, you're going to need some cash to operate, and if you're going to borrow, the bank will lend you the money, but what's their collateral? Your receivables and your inventory. So the inventory value on the balance sheet could affect the decision whether or not to lend money. Now, if a banker is reasonably informed and understands the accounting methods, then that loan officer in the bank will understand whether you have an over, and we're going to be back to those terms, over or understatement of the inventory based on these methods. Okay, so now let's go. I want to go back to, yep, sure, question? Less than, was there a typo up there? Less than first out. Yeah, you're right. There is a typo. That should be last in first out. That's not mine. That's the publisher. So it's last in first out. LIFO. So it's first in first out. That should be last in first out. Okay. Thank you. There's no such thing as. Let me just make a note on that. Okay. Okay. I'll correct that. All right, so any questions on the issues? So these are the issues that we need to address when we look at these inventory valuation methods. Okay. Okay. Now, when you go back here, don't forget you got a beginning inventory, and that beginning inventory is going to be at 700, The purchases, and I'll put this up on the screen in a second, you got 4 at 360, and you got 12 at 380. So you went out and you purchased another 6,000 during the period. So again, if we look at the allocation issue, and I want to keep going back to this, where we can use a cost of goods sold formula as well. So let me use a cost of goods sold formula this time. So your beginning inventory is going to be 2 units at 350. Then you had purchases. Make sure it's on there. Bring that up a little bit. And we're not really worried about discounts and things like that in this problem. You got 4 at 360, and you have 12 at 380. So that would be 1440, and that's going to be 4560. So you purchased 6,000, and the total available goods available for sale is 6,007. Now we're going to keep that number because that number is not going to change in a lot of our examples, or in all of our examples. We're going to need to allocate that, and depending on whether you use first in, first out, last in, first out, specific identification, or average cost, it'll change the way this is allocated. This is going to be allocated to both the cost of goods sold and to ending inventory. So that total amount has to be allocated to cost of goods sold and to ending inventory. Okay. So that's the inventory allocation issue. And remember, when we go back and repeat what I said, that this is important because of the income statement and this is the balance sheet. All right, so what makes this important is that 6,700, if allocated differently, can give you a different net income. If allocated differently, it can give you a different balance sheet value. Right? Now, let's go into the methods. Let's take the first one. This is going to be all perpetual. Someone asked a question about periodic. Periodic is in the appendix. It is done. You have a little homework on that, but for us, we're going to worry about the periodic system. All right, so we'll go to the periodic system. And the first method is specific identification. Here, you could specifically and absolutely identify the units you have left and the units that you've sold. You do that through a stock number, a vehicle identification number, real estate, you have lot numbers for property, very easy to identify. This method is used for companies that sell relatively low volume of high dollar items, items that you can keep track of pretty easily. Now, the rest of the slides are going to basically walk us through the following example. So I'm going to put the example up on the DocCam. So everything you see here describes, and that's for your own use, this describes exactly where we're going to be going on this slide. So I'm going to put it on the DocCam so I can point out a couple of things to you, but it's actually going to be the same. So we'll leave that up. We'll get back to that. Now, this is, make sure it's on the screen. Okay, here we go. All right, so the beginning inventory, we started with 2 units, and we paid $350. And you start the year, the month. In this case, you mentioned it's a monthly inventory. You start that with $700. Then you go out and you buy 4 units at 360. So now your total inventory is 1440. You've got two different layers of inventory or two different batches at different prices. On August 15th, there is a sale of 4 units. So we did sell 4, and we need to find out where they came from. Now, again, some of you started the homework. What could you do? You could take an average. You can make an assumption that the first one's in or the first one's out. You can make an assumption that the last one's in or the first one's out. In this case, we're telling you that we're able to identify exactly that out of the 4 units we sold, one of them comes out of the beginning inventory at 350, and 3 of them come out of the August 5th purchase. So we're able to identify those exactly, and my cost of goods sold is now 1430, and my ending inventory would be 710. And remember, when you sell something, it's coming out of inventory. Remember the journal entries? You debit accounts receivable, credit sales, you debit cost of goods sold, and credit inventory. So right here is like the debit to cost of goods sold and the credit to inventory. So you would have to be told exactly. So this is a problem. Everyone worries about exams. I'd have to tell you exactly. So pretty much giving you the answer, so you probably would not necessarily see a question like this except in concept. But I would have to tell you that out of those 4 units, 1 was sold from the August 1st batch, and 3 were sold out of the August 5th purchase. Okay? Now we're going to continue this illustration, but questions on specific identification should be, I think, relatively easy because everything's right there. I mean, you're given the information. Okay. All right, so let's go to the next one. And again, you have all the slides there as well. And this one continues. So I drew a line from where we were and where we're going to go. So now they're telling us, in continuing the illustration, now the authors tell us that on August 26th, they purchased 12 more, but now the price goes up. So you're starting to experience inflation. The price goes up to 380. So now you add to your inventory 4560. But on August 31st, you sell 10. Again, this is relatively easy because I would have to tell you that one of the units you sold came out of the beginning inventory. Now there's nothing left in there, right? That's now down to 0, the beginning. And 9 of the units come out of the August 26th purchase. So you sold 1 at 350 and you sold 9 at 380. So your cost of goods sold for that period, or for that date, August 31st, is 3420, and you reduce inventory. Now, once again, notice that you have 2 units at the beginning, 16 were purchased, that's 18. You sold 14, so there's got to be 4 left. The 4 left in inventory are going to be identified, which I'll do in just a minute. But what I wanted to point out is how much is the total allocation between ending inventory and cost of goods sold? 67, correct? So you now are allocating for the month of August $5,200 to cost of goods sold and $1,500 to ending inventory. So if we go back to our, and I'll put this right back, if we go back to our base illustration, in this example, cost of goods sold, if you take specific identification, cost of goods sold is $5,200 and ending inventory is $1,500. So the allocation will be $5,200 going to the cost of goods sold, the income statement, and the balance sheet is $1,500. All right, so any questions on the specific identification? Yep. Question, I'm sorry. Yep. Yeah, specific identification, I basically have to give you the answer. I have to tell you where to get them from. Right.
So like the difference only lies between like how much you pay for it when you buy it, but like if you pay it for like the 350 and you need to sell it at the same quantity.
Well, no, you'd sell it for more than $350, but you'd have to, So we don't know what the selling price is, because don't forget, here, you're going to now have a selling price of those 14 units that would be higher than 5,200, right, to get your gross profit. So we don't have the selling price yet. And you have to be very careful. By the way, I was looking at some multiple choice questions that I have in the back of the module, of the learning objectives of the modules. And some of them give you selling prices, but if you're trying to value inventory, the selling prices are not relevant. So you don't really need those. So just, you got to be careful there as well. Okay? All right, so the ending inventory is 1,500, and the ending inventory, let me put this back up for you. The ending inventory is going to come from, you're going to have 1 unit left out of this purchase. So remember, the August 5th purchase, you only sold 3 out of it, so there's 1 left at 360, and you sold 9 out of the 12, so you have 3 left at 380. So when you look at this slide, it also gives you the breakout of the composition of the ending inventory. So when you go into next month, starting September 1st, what does your beginning inventory look like? Your inventory would show 1 unit at 360, and it would show 3 units at 380. So your ending inventory of August becomes your beginning inventory of September, and that carries over. Any other questions on specific identification? So I would have to tell you absolutely what is coming out, or what you're selling and where you're selling it from. Now, most businesses that are going to, let me put this back up on the screen for you, sell a very large volume of goods, and prices are changing rapidly, would have to start thinking about adopting a particular cost flow assumption. Now, the choice of the cost flow assumption could be motivated by lots of things. It could be what you want to show on your balance sheet. Sometimes they have tax implications, but the FIFO method assigns the most recent cost to ending inventory and the oldest cost to the cost of goods sold. If the first one's in or the first one's out, then your cost of goods sold have to be the oldest. And what you have to start thinking about more analytically, from an accounting perspective, yes, you have to know this as well. But we're thinking about a broader range of majors in this room. And if you're thinking about this from a management issue or a finance issue, if prices are going up, and if I assign the most recent cost to ending inventory should be higher than under the other methods, correct? Because I'm now, with inflation, the most recent, the newest costs are going into inventory, and the older costs go into cost of goods sold, which should be lower. And if I have lower cost of goods sold, what happens to profit? Goes up. So you have to think about the profit or the income implications as well as the inventory implications. By the way, we're not going to think about taxes to any great extent. As I said, it's a separate course. But you have to remember, if you don't think about taxes, all of these accounting methods are pretty much what I would call cosmetic. There's no cash involved here because you've already spent the cash to buy the inventory. So if you look at this diagram again, you've already spent $6,700 on inventory. The way you report the numbers doesn't change cash. Just want to make that clear. So if you spend $6,700 on inventory, the way it's reported does not affect your cash at all. Just a matter of whether or not you get a method like specific identification that allocates 15 to ending inventory, 52 to cost of goods sold. A different method will have, obviously, a different result. All right, so now let's do that. As I said, we're going to skip all the narrative there and get right into FIFO. So let's go into the FIFO method. And the narrative just really is nothing more than describing what we're going to see in this analysis. Okay. So, once again, we start with 2 units at 350 or 7. We buy another 4 at 360. And that's 1440. That's my total inventory at this point. All right, so here's the key. On the 15th of the month, we sell 4 units. The first one's in or the first one's out. So the first two come from the beginning inventory, first in, first out. So when you sell them, that means that 2 units come from first out of the beginning inventory, and then of course the next 2 have to come from the next purchase. So the cost of goods sold in this case is going to be 2 at $350 and 2 at $360. So your cost of goods sold is $14.20 at this point. Now, I'll take some questions in a second. You buy another 12 at $380. So now your inventory is building up. On August 31st, you sold 10 units. They're going to come out in a first in, first out basis. There's nothing left in the beginning inventory, but you still have 2 units left out of the August 5th purchase. So the first 2 out of the 10 you sell here come out of the August 5th purchase, and the 8 come out of the August 12th. So you sold 2 at $360, and you sell 8 at $380. Now again, it's a little bit tedious, not difficult. You just have to understand that you sell the first ones in are the first ones to be sold. So the oldest units are going to be sold first. Now the more recent units, obviously we always have 4 units left. I'll get to that in a second. But if you add this up, once again, by adding up the cost of goods sold and the ending inventory, you now have, it should be $6,700. So now the allocation here is a little bit different. The ending inventory right now, you've already exhausted the beginning inventory. These 4 units are coming out of the August 5th purchase, and the only units you have left are what? 4 units at $380, right? Because you sold 8 out of that batch. Now you notice that the ending inventory is 4 units at $380. It's your most recent cost. So, for example, I'm looking at some of the multiple choice questions that say, I want to know the ending inventory under FIFO, and I give you this whole balance sheet analysis. Well, that's inventory analysis. It's important, but the short end of the story is under FIFO, the ending inventory is what? The most recent cost. So that if you have 4 units left, it's only going to be, it has to be coming out of that last purchase at $380. So you can really make it simple if you understand the implications. And again, on the next slide, which I'll put up, and go back to this. So again, this is, this is also pretty clear. I just can't point things out to you. But if you notice that, if you look at the blue line, okay, first of all, the green line, that's gone. You took all your beginning inventory out. The red lines, you exhausted the August 5th purchase, but the 26th is going to have 4 units left at $380, and that's it. And then, of course, the sum of the 2 should add up to $6,700. So when you look, and we're going to do a comparison in a second. And also, by the way, this is, what they show you here is just a formal record. This is what a formal perpetual record would look like, but that doesn't have anything different than what we've just looked at. Now, before we take any questions or go on, I just want to tell you that if you go to FIFO, ending inventory and cost of goods sold, of course, would be different. So the allocation of the $6,700 changes now. Now, of course, it's not extremely significant, right? It's a difference of $20, but as you would expect, if we use the FIFO basis, it's going to always have current cost in the ending inventory. And we'll get back to this. It's not very easy, and we do a comparison in the next learning objective. It's not very easy to see that comparison until we go into the weighted average or the LIFO basis. Okay. Any questions on first in, first out? Yeah, let me.
Go to slide 39.
Sure, let's go back. This one, right? That the one? Yeah, okay. That's it? Oh, of course. Sorry. There you go.
Okay, so I understand that the purchase, like you purchased,
And I'll repeat the question again.
you purchased 16 in August and you sold 14, so your balance in August is 2, but how come it doesn't take up the beginning balance from the previous one?
Okay, so let's see this again. Well, it does because your goods available are still 18. So even though you purchased 16, your goods available is 18. So what's happening is if you take those 14, and those are the 14 you've sold, 2 of them came out of beginning inventory, and the other 12 came out of current purchases.
If I purchase mine sold at 380,
Right,
I'm obviously going to sell it more expensive
Right.
than I sold the other expensive ones, correct?
right. So the selling prices are not there, but they would be, the question is, would the selling prices be higher? Yeah, you'd probably be raising your selling prices.
Let's say I don't record the last 2. I recorded at 380. Will I get penalized when they check the books?
If you don't record which 2?
The last, well, the 2 that are left in August 5th, that you were recording at 360. So let's say I just recorded at 380.
Oh, if you make a mistake and,
Or no, let's say I just want to make a profit off of those 2. Because if they're already selling at 380,
yeah, that's not your selling price though, because you can raise your selling price. So you can make up for that $20 difference in your selling price. So you don't necessarily have to manipulate the inventory. You can raise the selling price if you could.
okay, so
Right. Yeah, right. Now, normally in a period of inflation like this, you do get obviously you get higher profit anyway, and I'll show you.
Okay.
Yep.
So what if, like, the earlier inventory don't get sold? What happens if they don't get sold?
Okay.
How much people are buying?
It's a real good question because what we normally don't emphasize in intro is that the units are gone. It's just the cost we use to price them. So, for example, those units have to be gone. If they're not gone, we'd have to mark them down because they'd probably be obsolete. But technically, this method, and that's what I was going to do next, when would you use this method? What kind of business would use a method like this? Products that are perishable, products that are subject to style change and obsolescence. So if you're in electronics, you're going to sell your oldest units first in, first out. If you sell clothing, you're going to sell them, you don't want to keep old items in stock. If items are going to perish or are subject to spoilage, like food or other products like that have expiration dates, you'd sell them first. If those are not sold, you would probably have to write them off as obsolete or spoiled. Okay? So the original purpose of FIFO was for companies that sold items that were either subject to spoilage or that would be perishable, that would be subject to style change or subject to obsolescence. And this method captures that. So you would use this method if your and most businesses would in fact operate this way, I would think, correct? I can't think of a business that would operate any other way except to sell their oldest goods first, if they could. Right. Now, when goods hang around, you have to write them down. In fact, if you look at what are they giving away now? I guess the Dish Network gives away iPad 2s, right? They give them, if you sign up for the Dish Network, they give you iPad 2. They probably got them, for almost nothing, right? So obsolete items are either written off completely to zero or they're sold at a loss. And again, if you sell them at a loss, it's better off than just giving them away because at least you get something. Right? So it's a good question. If you actually don't sell those units, then you would have to write them down. Okay. All right, any other questions? All right, now, this next method is really, and incidentally, this is just a summary of that, a formal perpetual record. All right, now, here's the LIFO method, and this one is odd. The LIFO method says that your ending inventory are your oldest cost, last ones in are the first ones to be sold, and the oldest inventory is sitting in inventory. Now, the oldest units may not really be there, and I'll explain that to you in a second, but it's very strange to see a business that runs this way. Can anybody think of a business that runs on a last in, first out basis? In other words, the last units in are the first ones that you sell, and all the old ones are still there. I mean, in reality, if the units really flow that way. No, it's the other way around. This is saying that as soon as the fresh food comes in, you sell it, and if you had something left over from yesterday, you just leave it there. You don't want to do that. No. Car dealers want to sell the old stock first. Again, was yeah, maybe if you're aging, but
What about like when Apple releases a new product?
it promotes, yeah, but you still have to get rid of those old ones first, so you have to discount them. I'm thinking about, anyone take the geology class here yet? All right? Yeah, they take it to one of those, they take you to Roseland, the quarry, right? You got to go to that. Well, that's an example, because what they're doing is they're mining the gypsum rock, and they're throwing it into a pile, and when they use it, they take it off the top. They're not going to take it from the bottom. So a mining operation is possible. Any kind of item that doesn't spoil. So for example, if you're in a factory and if you're manufacturing a product that uses, metal products like nuts and bolts, and you've got a bin full of nuts and bolts and you never really get to the back, you just keep piling on and just taking it. So you usually use the newest ones first, maybe, but it's not seen that often. So you have a very difficult time justifying it. Now, I'm going to tell you why it is popular in the United States. LIFO is popular in the United States because it is a tax method. Now, as I said, we're not going to do much tax, and we're not going to do any tax, but it is a tax method, and that's what increases its popularity. So for you, not necessarily an accounting major, but for any other major in finance or management, what you're looking at is if you're managing your business and you could choose the LIFO basis, and if prices are rising, what does it mean? It means that you assign the most recent cost to the cost of goods sold. That means in a period of inflation, you could deduct the highest prices that you have in your inventory, and that gives you the lowest taxable income. So it has gained popularity because of tax usage, but in reality, it doesn't have much practicality in most businesses, but we'll see. All right, so let's go through our example, and I'm going to put this up on the doc cam again so I can point some things out to you. So this is on slide 45. Okay. So once again, we have our company starting on August 1st with 2 units at $350. Then they buy 5 units at $360, and that would give you $1,440 added to the inventory. Then on August 15th, they sell 4 units. The last ones in are the first ones to be sold. All 4 come out of that last purchase. Beginning inventory is the oldest cost. Cost of goods sold is the most recent. So just picture a legitimate case where you're dealing with a factory that's selling nuts or using nuts and bolts. You got 2 of them sitting in the back. You buy 4. You need 4. You're not going to take the 4 new ones out. You're just going to grab them and start using them. So you use the newest ones first, and that becomes your cost of goods sold, or you sell the newest ones first. Then you buy 12 units at $380. Selling 10 units, where do they come from? They come from the most recent purchases. So you sell 10 at $380, and that becomes your cost of goods sold. Now again, your ending inventory of the 4 units, you still have the 2 left in beginning inventory, but you have 2 left at $380. So if you look down on the bottom of the screen, you'll see that your ending inventory is going to consist of 2 units at $350 and 2 units at $380 for a total of $1,460. So your ending inventory is $1,460. Cost of goods sold is $5,240, and the total is once again $67. It has to add up to the total amount of goods available. Now, of course, this method is not very realistic for a company. Let's go back to Apple selling electronic products. I mean, they're going to mark them down to get rid of them, right? So, and even automobiles. I mean, you see these prices in September and October, even late August, when the 2013s are starting to be sold off, and the 2014s come out, new cars come out around September, August, September. So all the 2014 models are coming in. You got to get rid of the 2013. So, September to remember, all these sales that they have. Obviously, they're not selling you 2014 at those discounts. They're selling you 2013, and they're knocking down the prices in order to get rid of the older inventory. So you really don't keep inventory that's old, you may be assigning an old cost to inventory, but you don't really keep the units, except for, as I said, legitimately a mining operation. Now, when we compare this, and this is the key, if we compare, we're going to do a scoreboard in a second, a formal. Okay, we'll do a formal one in a second, but if you now compare them, 5240 of cost of goods sold against 5180, you got lower profit under LIFO. You got lower profit under LIFO. Okay. Also, you have a lower ending inventory. So we'll get back into these comparisons a bit later. But again, the method will still allocate the total of 6,700. All right, so last in, first out assigns the newest cost to the cost of goods sold. The oldest costs remain in ending inventory. All right. Any questions on LIFO before we take a look at average cost? Okay, and again, we go back to slide 45. And once again, slide 46 is really nothing more than a formal perpetual record. Okay. All right. Now, the last method we could use is average cost. And average cost makes sense for companies that are selling indistinguishable items, very homogeneous goods they sell in large volume. For example, fuel oil, right? I mentioned before the tankers, you fill up half the tank today, you fill up again tomorrow, prices change, those prices have to be averaged in. Today, most companies use the average cost method. I'm sorry, wrong one. Most companies will use the average cost method for very low dollar inventory or supplies. Now, when we take this average cost, we're going to take an average every time, or a new average, every time an item is purchased, and that item is, or that average is used when the item is sold. So you only calculate a new average anytime you have a purchase, and then when the item is sold, you'll have that same average used against the cost of goods sold. And let me just show you how we calculate the average. The average is calculated as the total cost of goods available divided by the total number of units that are available. So, for example, we're going to use this illustration. And we'll get back to our base example, if on August 20th you have a total cost of $27,900, and that's the total cost of goods available for sale. If the units in inventory are 12,400, the average cost is $225. That average cost is going to be used for your cost of goods sold. So if you sold one unit, it would be cost of goods sold at $225. That cost will not change until you buy more inventory. So the ending inventory will stay at an average cost of $225. It will not change unless you buy more inventory. So until new inventory is purchased, you would not have a change in that average cost. So the average cost remains until you purchase more inventory. Now, if we go down to the illustration, these are all the narrative from the illustration, and again, I'm going to need to use the doc cam for this because I think a little easier to see. See if I can bring it in a little bit more. Okay. All right, so when you take a look at the opening inventory, the beginning inventory, and I'll try to bring it in as close as possible and then move back if I have to. The beginning inventory has 2 units at $350 or $700. The average cost at that point is $350. So the average cost at that point is $350. Then I purchase 4 units at $360, and I now, if I'm looking, I'm sorry, it's the wrong one. Ooh. Sorry about that. There we go. Okay. So once again, sorry about that. Here we go. I purchased the 4 units at $360, and now if I look at my average cost, how do I get it? My average cost is the sum of the total cost in inventory. So I've got $1440 purchased, add that to the beginning inventory, so my total cost of goods available at this point, let me come in a little closer on this one. So I have 700 in beginning inventory. I have 1440 that I just purchased. I'll move that over. I just purchased 1440, and I now have 2140 as my total cost available. I have 6 units in stock, so my average cost is $356.67. So I started out with an average cost of $350. I now have an average cost of $356.67. Now, that average cost is used to value the cost of goods sold. Remember we said at the outset today that what we need to do is value ending inventory and cost of goods sold. So now we've got $356.67 as your unit cost. When you sell the inventory, that's what we use to cost of goods sold. So when I sell off, if you go to the sales column, when I sell off move that over again. When I sell off 4 units, I sell them at $356.67, and my cost of goods sold is $14.27. Notice that a sale does not change the average cost. I just want to make that clear that you only change the average cost when you have a purchase. You do not change the average cost when you sell it. The average cost is used to value cost of goods sold, but it does not change when you sell. Because you've got, when you look at it, the average didn't change, you didn't add to that average at all. And then finally, when you make this last purchase of 12 units at $380, that's going to add $45.60 to the total. And I'm just going to see if I can make this a little wider. It's $45.60 to the total. If you add that to your opening balance of $713, you now have 5,073 units on hand. Divide that by the 14 units that are in inventory at this point, and your average cost goes to $376.64. So your average cost goes to $376.64 after the purchase. So anytime you buy a new set of units, it will change the average. And how do we get that average? Again, it's the $56.60 plus the $713 divided by the 14 units. So at every point in time, it's the cost of goods available for sale divided by the number of units. And then when you go to sell the last 10 units, it's going to be $376.64 is your cost, and your units in ending inventory, the average doesn't change. So your total cost of goods sold is $51.93, and your 4 units that are left are at the average cost of, same average cost of $376.64. Now once again, the total, $51.93 and $15.07, is going to be your $6,700 that you've been working with all the way through. So if you look at, once again, our last method, if we take the average cost has $51.93 and $15.07. Okay. Now I'm going to put this up in the next learning objective, but notice that the average cost, as you would expect, falls in between the 2 extreme methods. So the 2 extremes are first in, first out, last in, first out, and the average cost should fall between those 2. And if you are looking at a way to sort of check logic, or if you're looking for a way to validate your answer, just remember that the average cost should be between FIFO and LIFO. Question?
For special inventory, this is all right. For first in, first out is
I'll repeat the question. Go ahead. Oops.
for first in, first out.
Yeah, that's right.
For first in, first out, your cost of goods sold went down. For last in, first out, your cost of goods sold went up. Well, that always happens.
Okay, where are we? So for this one, you mean, right?
First in, first out, your cost of goods.
Okay. What's that? I'm not going to worry about specific identification because that's kind of random.
Okay.
All right, so let's just see what happens between these three. We're going to pick this up. As I said, the next learning objective is dedicated to talking about this, but I will answer the question. In a period of rising prices, and this is what you really need to capture, or what you really need to understand, is that when you think about the methods, just understand how the methods are described. It says that FIFO assigns the most recent cost to ending inventory and the oldest cost to cost of goods sold. So in a period of inflation, ending inventory should be higher under FIFO because these are the newest costs. And if LIFO assigns the newest cost to the cost of goods sold, then it should be the highest cost of goods sold in a period of inflation. So we're going to talk about that in just a few minutes. All right, so are there any questions? I'm going to ask you a few now, but any other questions on this? I'm just going to ask you a couple of questions. In fact, I'm going to start with a question just like this. Yes? What if there's a?
Like the damage or the theft?
When I got to come, so roll down please, because I can't hear the question. If there's a, I can't get that last way. Oh, shrinkage. In other words, a loss in inventory. Yeah, we debit cost of goods sold, and we credit the inventory. If inventory, the question is if there's inventory spoilage or shrinkage for any reason, you would debit cost of goods sold and credit the inventory under all three methods. Hold down. I can't. Go.
So that is like an adjustment process?
Yeah, an adjustment. Yeah. So the question is, again, if there was, let's say, damage or theft or any kind of spoilage, that comes out through an adjustment process. That's the adjusting entry. You debit cost of goods sold, and you credit the inventory account. Okay? And that would be true under all of these cases. Okay. All right. So let's get a couple of simple questions out. All right. So let's go to the first one, and first one says, under last in, first out. It's not up. Okay. Thank you. That'll help. Under the last in, first out method, the cost of goods sold is based on the oldest purchases. All right, there we go. Sorry, the clock may not be working, but you should get this one pretty simple. I'm keeping track. This one should be easy, but we'll see. Never know. Okay. I'm going down to about 10 seconds, but I'll let you know when there's 10 seconds. So there's 10 seconds. Okay. Ready? All right. Okay. All right, so now the answer is false. Okay? So 7%, didn't know this. If you're a part of that 7%, let's make sure you understand that under LIFO, it assigns the most recent cost to the cost of goods sold, the oldest cost to the ending inventory. Remember those two units that are sitting, or think about the pile of coal or gypsum rock. If you're using the newest units, cost of goods sold has to be the most recent. All right, the next one I'm just going to give you. You should know that this one is, if it says FIFO, the cost of goods sold relates to the most recent, and the ending inventory is the oldest. Well, if the first one in is the first one out, it's got to be the oldest. So cost of goods sold under FIFO is the oldest. Ending inventory is the most recent. Ending inventory is the newest cost. First in, first out. The old ones are gone. I had a professor at NYU that told us that if you don't understand FIFO, you could basically change the name of the method to LISH. Last in, still here, right? And if you don't remember LIFO, remember the word fish. First in, still here, right? So this is LISH. Last in, still here. Last in, or the newest, and therefore that would be false. Okay, so this one would be false. And of course, the actual cost here would be specific identification. All right, so now, here are the real ones. All right, exam simulated question. Exam simulated question. All right, so let's see. Now, a lot of computations on the next exam. So let's see what you would do here. I'll read it to give you some cheat time. The company purchased 100 units at $20 each on January 1st. It purchased another 100 units for $30 on February 28th. It sells a total of 150 for $45, and from March through December when they made their sales, the company uses last in, first out, and I want to know what is their ending inventory. Last in, first out. Okay, you got a minute, and here we go. Okay. It's not open? Oh, I thought I hit it. Sorry. All right, thanks. All right, here we go. Now you got a minute. There we go. All right, good. Sorry about that. All right. We're going about 10 seconds here. All right, so if this is a test, you guess, right, at this point? Okay. All right. All right, so we're all over the place as expected. Okay. Now, all right, this one, let me, I'll give you the answer by doing this quickly. First of all, the selling price in there doesn't matter. So if anyone used $45 for anything, that selling price is totally irrelevant, does nothing. We're worried about the cost. Now, it tells you that there is an ending inventory. We need to find out the ending inventory. So look, how many units did they buy? How many units did they buy? 200, right? So they bought 200 units. So just very quickly, you have January 31st, and then on February 28th, they purchased 100 units. and this was at 20, and this was at 30. So that's how many you have available. How many units did you sell? Sorry. Sold, what, 150? And the inventory is 50 units. If this is last in, first out, quickly I know where the end of the inventory has to be is the what? The oldest cost? If you know the definition, the LIFO, and this is LIFO I hope, right? Yeah, okay. It's LIFO. Ending inventory is the oldest cost. So I got 50 units at 20. So now on the exam, I'm going to expect you to be able to do that, and if you got like 30 or 40 questions and you're playing around with schedules, how many people actually built a schedule? Raise your hand. It's not to be, nobody? Yeah. So if you built a schedule, it could take you too long. So you have to be able to reason these out and understand that it's got to be 1,000. So 55% of you got this right. So I'm just going to tell you the answer is C. The answer is C. Okay. All right, so we're going to try another one. We're going to try one more and then we're going to move on. The next learning objective is really quick. So, and again, it is 2:13, right? 2:13. Got 7 minutes to go. All right, so you take a minute on this one, and then we got about 6 minutes to do the comparison. All right, so here we go. All right. All right, so I want to know about this company who is now using, wait, one more FIFO, right? Whoa. There it is. All right, so this company uses FIFO, and make sure, and again, I'm getting you prepped, for the exam as well. You need to think about a couple of things. The information given. Also, when you study accounting or any subject, read the requirements first. So I want the cost of goods sold. So you're going in the opposite direction this time. So what's the cost of goods sold? And company, and I'll give you some cheat time as well by reading the question. Company is starting the year with 200, buys 150. Once again, it sells 100 at 50. The selling price is meaningless. They use FIFO. What is the cost of goods sold? So let's fire this through. Okay, so here we go. Okay, you got about 5 seconds. Okay. All right. Okay, so your answer is A. Okay. All right, now, here's why. Here's why. If you're using FIFO, and I want the cost of goods sold, I mean, first in, first out. So the first ones in are the first ones you sell. So if I sold 100 units, right, because it tells me I sold 100, I don't even have to go through this whole schedule. In fact, I know I sold 100, and it has to come out of the 30, right? So it's as simple as that. That one is like one of those questions if you really got it, all right? Okay. All right, so just two examples of what you would need to do with these methods. Now, with the remaining 3 minutes, all right, here's the comparison. Let's go through this comparison again. Now the table, if you're looking at slide 64, which I could put on the screen. Okay. All right, so if you're looking at slide 64, you need to ignore, in a sense, the specific identification, because that's kind of random. You really don't know. If you look, what's going to happen every year. But if you look at the comparison of FIFO, weighted average, and LIFO costs, here's some of the things you need to know. And again, on the exam, you are going to get lots of these multiple choice theory questions. So notice that the average cost falls in between the two extremes. When you look at your balance sheet, on the ending inventory, FIFO gives you the better balance sheet amount because it's as close as possible to current cost. Okay, so it's as close as possible to current cost. Meaning that if I needed to think about collateral for a loan, that number is a lot better than the LIFO number because the FIFO number is representative of the current marketplace. It's the current market cost. On the other hand, LIFO understates inventory, right? The inventory is too low under LIFO, really using the old cost. On the income statement side, if you look at the cost of goods sold, when you look at LIFO, it gives you the highest cost of goods sold. So if I was managing this business and I wanted to use a method for tax purposes, I would use LIFO. Only if what's true. What's going on in our examples? Were prices rising or rising? So you have inflation. So this table is only valid in a period of inflation. And then, of course, if you look at FIFO, if you read the book, did they use the term, paper profits or phantom profits? When you use FIFO, you wind up with a very low cost of goods sold, which expands your profit margin. So, again, this is your comparison. All right, so now we'll see you on Friday. We're probably going to be done with this. We might be moving into receivables.